Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by Takahiro Sekido, Chief Japan Strategist for MUFG. It's Monday, April 17th, 2023. Welcome back to the podcast, Sekido-san.
Good to be back.
It's good to have you. So why don't we start today's episode by going over recent price action in the Tokyo market, as well as some of the March securities flow data that was recently released. These things are obviously interrelated, as you know, as the securities flow data can and often does explain price action.
JGB's rally after Silicon Valley Bank was unexpectedly put into FDIC receivership on March 10th. The rally, however, proved short-lived in the long end, causing the curve to steepen somewhat. The dollar-yen took many by surprise, dipping below the 130 mark on March 27th, although it has since recovered. The yen basis has not widened, suggesting that Japanese investors have avoided higher funding costs for dollar assets. Tokyo markets have reacted to the credit events in the US and Europe differently from during past financial crisis, where JGBs and the yen rallied while yen cross-currency basis widened. In March, Japanese investors purchased a net 5.4 trillion yen of foreign securities, up from 1.8 trillion yen in February, according to the data released by the Ministry of Finance on April 10th. The buying was driven by 5 trillion yen of buying of medium to long-term foreign bonds, and less so by buying of 195 billion yen of foreign stocks and investment fund holdings, and 141 billion yen of short-term foreign bonds. Among medium to long-term foreign bonds, Japanese banks drove most of the purchases, buying 4.1 trillion yen, while the pension bought 455 billion yen, and the lifers only purchased 12 billion yen. Although small, this was the first time of lifers that have buying foreign bonds since February 2022. In March, overseas investors purchased a net 3 trillion yen of Japanese bonds and unloaded 3.6 trillion yen of Japanese stocks. When the market was uneasy about credit in the US and European banking sectors, Japanese investors were actively selling stocks and buying bonds.
Yeah, that Japanese investor buying of foreign bonds is really, really amazing. And, as you mentioned, lifers turn buyers, although small, they turn buyers for the first time in a really long time. And that bank buying was just huge. I'd add that the bank buying comes after very, very large buying of similar size, the previous month. So pretty large change in trend to those flows. And to be honest, kind of caught me off guard, at least personally.
Right.
Yeah. So moving on, but related, that same balance of payment data release contains some more, like, I guess I'll call it wonky data that perhaps a more casual observer would ignore. But you obviously are anything but a casual observer. And I would argue that that stuff can be really key to understanding the underlying dynamics that determine price action. So why don't you take our listeners through some of that data and how it might suggest structural changes in the Tokyo market?
Japan logged a current surplus of 1.2 trillion yen, a trade deficit negative 22.7 trillion yen, and income surplus of 34.3 trillion yen in January and February 2023 annualized, according to the balance of payment data. In January and February annualized, Japan's trade deficit resulted mostly from the import growth of 109.5 trillion yen, huge, outpacing the export growth of 86.8 trillion yen. The balance showed direct investing increased by 22.2 trillion yen, and the securities investing increased by 47.5 trillion yen. In our view, Japan's Overseas account structure reflects firstly, strong imports driving a trade deficit. Second, a big income surplus. And third, very active outward investing flows. Firstly, the yen rally was limited as Japanese importers' yen selling was so strong as energy resource imports continued intermittently. Regular yen selling flows continued despite credit jitters emerged in the US and European banking sector. And Japan's income account balance rose primarily because of the income from overseas Japanese investors' overseas business portfolio, combined with dividend and interest income for the Japanese institutional investors, resulting in a current account surplus. Also, the Japan's corporate sectors continue to invest directly overseas as income from overseas business portfolios rose. Japanese institutional investors rebuilt their foreign bond portfolios, especially their U.S. Treasury holdings, turning from net sellers of foreign bonds by 25 trillion yen in 2022 to the net buyers by 11 trillion yen year-to-date in 2023. Such structural changes in a Tokyo market work to help prevent the risk contagion from the financial jitters in the US and Europe, as Japan supported global bond market.
It's interesting. So the what you said there at the end very much ties to what we were discussing, in the previous, question and answer, huge, Japan was a huge seller of foreign bonds last year, and they turned a big buyer, this year. I was noticing that the February US tick data just came out and it showed a decline in Japan's holdings of treasuries. So that data set is not exactly matched up to the Ministry of Finance data set recently, but interesting and may suggest that, Japan's, in addition to rebuilding the treasury holdings, they're rebuilding sovereign bond holdings elsewhere.
Right.
And then I thought you just made a really interesting point, which I'll just try to emphasize here. So you have strong imports, driving a trade deficit, and then, and that as well as the income surplus, and then the active, outward investing flow. So you have kind of, some conflicting like yen selling flows juxtaposed against yen buying flows, so important to understand the relative strength of any of those factors at any one time. Let's dig a little bit deeper into the direct investing, Japanese corporate direct investing overseas. Tell us a little bit more about that.
During my recent roadshows, the Japanese clients have been asking me why the major Japanese companies have been investing overseas so actively. According to the Bank of Japan's March Tankan survey, Japanese manufacturing and processing companies expect to increase the domestic investment by 5% year over year and overseas investment by 0.6%, showing a clear return to domestic operations. However, non-manufacturers clearly favor overseas business, given that they expect the domestic investment to increase by 1.7% year over year, while the overseas investment increases by 4.0% year over year. Interestingly, although the non-manufacturers anticipate overseas sales expected to fall by 2.0%, while expecting domestic sales to only fall by minus 0.2%, they still plan to continue to expand overseas. Japanese companies have expanded their overseas business portfolios because of the firstly, terms of trade, the weak yen, and secondly, the human resource constraints, and a third, to make room for growth. This deep-rooted investment practice is not only among the Japanese major manufacturers, but also medium-sized service companies. So should not be ignored.
Okay, so Japanese manufacturers kind of as advertised, they're returning production domestically, but
Mm,
non-manufacturers continue to expand overseas. Okay.
right.
And as you point out, despite, expectations that sales will fall. So that's pretty interesting. I think we're probably about out of time, but I do want to, make sure that we don't close things out with going over your outlook across various markets, yen rate, spot dollar yen basis. So why don't you take it through us? Why don't you take that through for us?
Okay. Sterling is up after the US CPI data release shows the inflation is moderating. The yen nominal effective exchange rate (NER) has declined as yen has weakened against not only dollar but also against other key currencies. At the same time, cracks are beginning to show in the strength of the yen selling flows. The new term will be a phase for confirming the conditions of the real economy, and we will be watching the US data coming out. We still see a neutral bias for dollar yen with the trading in a higher range 132 to 135. The yen swap rate curve has declined, especially the belly, amid the lack of impetus. Over the near term, market speculation about the new BOJ Governor Kazuo Ueda's policy stance could grow out of the 10-year JGB auction on April 20th and impact the long end of the yen swap rate curve. But otherwise, the curve could be neutral overall. The front end of the yen yield curve could decline if the TDB auctions are smooth. We now see a downward and steepening bias for yen rates. The value of the yen basis curve has widened, but like yen rates have lacked impetus. The Ministry of Finance data for April 2nd to 8th shows that Japanese investors sold a net 687 billion yen of overseas securities, net selling for the second straight week. This included net selling by 788 billion yen of overseas medium to long-term foreign bonds against net buying by 73 billion yen of short-term foreign bonds and 28 billion yen of foreign stocks and investment fund holdings. Japanese investors have taken their losses and gains on their bond positions at the start of this fiscal year. Over the same week, foreigners bought a net 7.6 trillion yen of domestic Japanese securities, including 3.9 trillion yen of short-term yen bonds, 2.3 trillion yen of Japan stocks and investment fund holdings, and 1.3 trillion yen of medium to long-term foreign yen bonds. Yen asset buying flows have been extremely active among the foreign investors. In particular, funds inflows into Japan stocks have been striking. Foreigners' TDB arbitrage flows remain strong, while the preference for JGBs has been strong among the foreign investors, together with the current uncertainties surrounding the global financial system. We now think the yen basis will retain its neutral bias.
Okay, so to summarize here, you're neutral on dollar yen, although you have a higher range. You have you're biased downward in rate, but steepening bias for yen rate, and then you're neutral on dollar yen. And as you mentioned, the foreign investor buying of Japanese assets very robust recently, so certainly something to watch. And I would just highlight that cross-border flows have just been massive both ways, positive and negative. So I think that's I would just suggest to our readers that they keep a close eye on that. So great stuff as always, Sekido-san. Plenty of good stuff to talk about next week, I expect. So I'll speak with you then.
Okay. Thanks for having me, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.